This is your Monex Metals Market Update with Mike Maroney.
Good afternoon. It's Thursday, January 28th. My name is Mike Maroney, and we're coming to you today from the Monex Precious Metals Studio. Today we had a very special guest speak with our account representatives. His name is Jeffrey Christian. He is the managing director of the CPM group, and he is the provider of the reports that we send out to our customers. We have the 2016 gold market outlook. We have the 2016 platinum and palladium market outlook. And we also, of course, have the 2016 silver market outlook. And Jeffrey made a presentation today that was absolutely tremendous, and hopefully I can ask him some questions about that presentation that will allow you to share some of the insight that he shared with us today. Jeff, we talked about being in the trenches for the last 4 years, but you said today that over the next 2 to 3 years, you think that we are going to see a radically different situation exist in precious metals. Could you extrapolate a little bit on that?
Try to do it a little,
because
it could go on, and you'll cut me off if I get too wordy. But yeah, basically over the last several years, 2-3 years, we've seen investors repeatedly reduce their perceptions of their near-term risks that they're facing. You know, the economy, the stock market, the real estate market have all been doing somewhat better. Not really fabulously better, but somewhat better, and investors have downgraded what they see as their near-term risks. In addition to that, you've had things not happen. You know, the Greek debt rescheduling didn't cause the euro or the European Central Bank to collapse. The monetary accommodation that we've seen has not yet led to any inflation. And so investors have become less and less worried, and they're buying less precious metals than they were in 2010, 2011. They're still buying historically very large amounts of metal. And you have a lot of investors who are looking at the world and saying, you know what, these problems that caused 2007, 8, 9, 10, 11 aren't gone. In fact, some of them, for example, debt, have gotten much, much worse. And other issues like structural labor market issues and international cooperation have also deteriorated further, so that you have investors buying precious metals actually taking advantage of the lower prices. What we think is that at some point over the next 3 years, you have a turning point and investors start raising their perceptions near-term risks. Those long-term problems that they're watching become shorter-term risks, and they start stepping up their precious metals purchases. And in the cases of gold and silver and palladium in particular, and to some extent in platinum too, we think that what you've got is the fundamentals are tightening. Mine production has been rising in gold, but it's going to start falling sharply by 2018. And that we think that the markets are getting tighter, so that when investors start increasing the amounts of gold and silver and platinum and palladium that they want to buy, even by small amounts, it probably will have a very powerful upward motion on the gold price or on the precious metals prices. And there are other factors in the market that suggest that you'll see a lot of the people who have been shorting the market may quickly reverse to long positions, accelerating the price increase.
Now, it's very difficult to buy a bottom. Everybody says it's much easier to buy new highs. And one of the things I think investors look for is they look for signals. Now, I know you work with central banks all over the world, but today you shared something as far as the PBOC, the People's Bank of China, and that was the announcement that they made on July 17th. And I think what that really did in my mind is it kind of gave us a floor in place maybe, or could you talk a little bit about that?
Well, first the People's Bank of China, it was a communist organization, let's be honest.
Right.
A lot of people forget that China is still a communist country. And for 60 years, the People's Bank has said, we don't see gold as playing a major role in our currency system, as backing our currency, nor do we see it as playing a significant role in our monetary reserves, the cash on hand that we keep to protect our economy from international economic problems. And in July, they came out and they made a bunch of announcements about moving the yuan toward convertibility and accelerating the convertibility process in the yuan. And part of that package of announcements was that they were changing their view toward gold. They were rehabilitating gold's view. And they said, we still don't see gold as having a backing for the currency or as being a dominant monetary reserve, but we do think that gold should play a more significant role in our monetary reserves. And as a result, we've bought about 19.7 million ounces of gold in the Chinese market mostly over the last several years. We're adding that to our monetary reserves as of June. And going forward, we're going to continue to buy gold and add it to our monetary reserves as we do, instead of holding it in a lump sum and dumping it in. And since July, you've seen 400, 500, 600,000 ounces a month being added to the Chinese central bank reserves. So the People's Bank of China has said, we think gold is a lot more important as a monetary reserve asset than we used to, and we're going to put our money where our mouth is and buy it. We think that's important for two reasons. First off, they'll probably be buying 6 or 7 million ounces a year going forward. And the second thing is that they have a lot of respect among central bankers. So, central banks will look at what the People's Bank is doing, and a lot of central bankers have been having this thought already. This will probably help them convert them to the gold camp. So we think that what you're going to see is greater amounts of gold being purchased by central banks, including the People's Bank of China, and especially the People's Bank of China and the Central Bank of Russia, which has been a big buyer over the last several years. We think that you're going to see much higher demand for gold from central banks going forward over the next 10 years or longer than we have seen over the past 40, 50 years.
Now that obviously creates an underpinning or a foundation, but one of the things you said is many of the central banks may actually follow the People's Bank of China's lead. What about the population of China? Do you think that they would respect that opinion enough to continue to take some of their money and invest personally in gold and silver?
Well, they have been. I mean, the individual private sector demand for gold in China, they've added about 50 million ounces of gold to their private holdings between 2008 and 2014. Probably another 5 or 10 million ounces again in 2015. So individuals in China have been buying gold, and I think that they do see the People's Bank's announcement as sort of like a government imprimatur. Yes, gold makes sense as a way to store your wealth and preserve your wealth and diversify your assets. In addition to that, they understand that the transition to a convertible yuan and the move in the Chinese economy from a managed economy that's growing at a higher rate to a freer economy, less controlled economy that's growing at a slower rate, the maturation of the Chinese economy is going to have some bumps and air pockets.
Right.
And so I think there's an increased interest in the part of Chinese investors to continue to buy and have gold in their wealth portfolio.
So the Chinese maturation process, obviously we've seen some severe volatility as far as their stock market. A matter of fact, the other day I think it was down 7.5%. We opened up the next day and actually rallied back. But you talked a little bit today about our stock market, and you felt that that could also be a key catalyst.
Yes. Let me just say one last thing about the Chinese maturation. The 6.9% or 6.7% growth in Chinese real GDP in 2015 in dollar terms was as great or greater than the 14% growth in 2007. 2007, the Chinese economy was probably about a $5 trillion economy. Now it's about an $11 or $12 trillion economy. So people who look at the percentage and say, oh, we're really seeing a massive slowdown in the percentage growth in the Chinese economy are missing the fact that it's still growing at the same pace in dollar terms, the growth in output. It's just that as you get bigger, it's a smaller percent.
Right.
In terms of the U.S. stock market, we have a stock market that has been rising very strongly into the beginning of 2015. And then in 2015, it moved sideways in a very volatile fashion. I think the high was probably made in June or July, I won't swear. And we're off about 10%, like on the S&P, from that mid-2015 high till today, or till yesterday, because the market's up a little bit again today. So you've seen the market looking like it's top. And that factors in with the view of the U.S. economy as having had several years of growth, anemic growth, but growth nonetheless. And we're sort of getting at a mature part in the economic recovery. We've become more vulnerable to a recession. And the stock market is reflecting that. So you're seeing the stock market topping off. Now, if you look at gold, one of the reasons why people have shifted away from gold over the last couple of years has been the strength of the dollar and the strength of the stock market. And if the stock market is no longer offering strength, it's offering greater uncertainty, very volatile moves, and 10% to the downside, investors start moving away from the stock market. I'll give you an example of my son. I bought some gold in early January, and I mentioned it to my son, and he said, yes, I bought gold on December 17th, the day after the Fed announcement.
Right.
And he's made a very good return on the stock market over the several years. So he's seen it, and other investors are seeing it. I think that the stock market is setting itself up and is vulnerable to another 10% downward move. And that is really going to shake the confidence of having your assets in the stock market on the part of investors. And that could be the trigger for increased demand in gold.
Now, when you think about the size of the stock market in comparison to the gold market, if we see a classic percentage as far as sector rotation is concerned, that amount of money could really move the price of gold.
Oh, absolutely. I mean, the gold market on a global basis is minuscule compared to the U.S. stock market.
Yeah.
And so it takes very little rotation out of stocks into gold to cause the gold price to rise disproportionately more than the stock market's falling.
Now, you were also talking today about the hedge funds, and interestingly enough, I talked to a lot of hedge fund players, and across the board, they've told me that a lot of money has come into their coffers that is predominantly supposed to be long positions. But you talked a little bit today about the COT and the current positions and how a big short position that is developed could start to reverse and could signal a potential bottom. Could you give me a little more information on that?
Unfortunately, there's not enough data on the futures markets to really understand what's going on. But the data that is there, the commitments of traders and the open interest and the gross open interest on a long and short basis by hedge funds and other institutional investors, we've seen an unprecedented increase in gross short positions, not only in gold, silver, platinum, palladium, but in oil, copper, and a variety of other commodities over the last 2 years. And what we think is that the vast majority of that short money is actually money that has been given to commodity trade advisors and other institutional fund managers by investors who are saying, okay, the stock market's looking top heavy, the economy's maturing, the economic recovery is maturing, commodity prices have been hammered down, I want to put some of my money into commodities. But I really don't understand the esoteric nature of all these commodities, so I'm going to give a professional money manager money to manage in commodities. And when they give it to them, because most of these commodity traders advisors are computer driven, and they don't necessarily study the fundamentals, and they don't necessarily take a rifle shot and say, well, gold looks good, platinum looks bad, copper looks bad, zinc looks good. They go to their computer and they say, what should I do with this money that's coming into our coffers? And the computer says short commodities. So we think that a large portion of the short position that's built up over the last couple of years actually is this kind of new money coming in. We've written about what we call the new shorts in commodities. That's important because if you look, now go back to gold and silver, the gross long open interest in silver is at record levels. The gross long position in gold is down from record levels about 30 million ounces in 2010 and 11, but it's still around 20 million ounces, which is very high from a historical perspective. And if you have these guys who are now computer generated, and their computers start telling them to lighten up or liquidate their short positions, they'll take that as a reason to go long.
Interesting.
So we think that what you see is the short positions that have been built up have helped push the prices down. And when they get liquidated, they're not going to go away from the market, they're going to go long. And they'll come into a market that's already got historically high levels in silver of long positions and very high levels in gold. And we think that that could cause the prices to rise much more sharply off the base than you would otherwise expect.
So I noticed that we had the Bloomberg Commodity Index trading at 2002 lows, And I think what you're saying is we've seen money move in, and maybe they even think they're long, but they see quality returns being on the short side.
Exactly.
And the definition of a short is a promise to purchase at a later date.
Right.
So that promise to purchase at a later date not only could be to cover shorts, but also to execute long positions. And suddenly we could see a dramatic shift as far as the velocity of an up move, which is typically a little bit slower than the down move.
Right. If you just look at the gross shorts and say, let's just say they liquidate these positions or liquidate most of them, you're going to see 10, 15 million ounces of short covering buying.
Right.
That's buying. When you cover your shorts, you're buying them back. So just if they just liquidate their positions, it's 10 to 15 million ounces of buying. And then if they say, well, wait a second, if my computer's telling me that I shouldn't be short, it's really telling me I should be long. If they take that money and go long, then all of a sudden you've doubled it. And you've got 20 to 30 million ounces of net buying, gross buying, as you liquidate your shorts and buy new long positions.
And I can imagine that maybe some of the money they haven't shorted with, and that money's sitting on the sideline, suddenly the market starts to move. They haven't taken exposure in the market. The last thing they want to do is talk to a client that wanted to be long commodities and isn't taking advantage of a big move. So that money could start to also chase the market a little bit.
Absolutely. Yeah.
And it's interesting. Now, we have some other events happening this year. You talked a little bit about the election. And I found it very interesting that you really kind of felt that the winner of the presidential election probably doesn't have as much of an effect as many people might believe.
Yeah, I think that my take is that whoever wins, we lose.
Okay.
I mean, I look at the current slate of candidates, and none of them inspire great confidence on my part. And I think that the way I look at the election is, it may not trigger immediate buying of gold and silver by investors who are worried about the consequences of a dysfunctional American political system. Because let's admit it, it's just more dysfunctional than it has been for the last 30 years
yes.
or so.
Yeah.
It's nothing new here. It's just an even worse episode than the previous seasons. So I think what the election does is it accentuates and increases this sense of ill-ease on the part of investors around the world. There's so many bad things happening, and there's so much gurgling around in the market. In Syria, it doesn't have an immediate effect on us or on the global economy. And terrorist attacks don't have an immediate effect on us personally unless we happen to be in that locale or on the global economy. But they help create this sense that things are not right, and there's an ill-ease, and there's, everybody's got one foot toward the door. And I think that the presidential election just increases that sense of ill-ease on the part of investors around the world, makes them more nervous about the dollar, makes them more nervous about the U.S. economy, the stock market, international relations, terrorism. And I think that that's the major effect that the election will have on investment markets, including gold and silver.
Now, it's interesting because the patriarch of the company, and I think you were just saying hello to Lou, he simplifies it sometimes as far as gold and silver pricing is concerned. He always tells me that all you have to do is look at the overall government debt. And if we have $17 trillion in government debt, in his mind, eventually gold will be trading at $1,700. Then he takes an 80-to-1 ratio as far as gold, and then he can figure out the price of silver. But what we've seen recently is a pretty big move up in the value of the US dollar, even though we're accumulating a lot of debt. Now, you talked today about the Fed, and I was a little bit surprised because you made it sound as if they still have a lot of powder left. And maybe they've been kind of jawboning and acting as if they don't. But you've talked a little bit about $4 trillion worth of paper being printed, but you thought another 40 could be available to them.
It's available, in a crisis. People will say that the Fed and other monetary authorities have run out of ammunition. But the fact of the matter is they have an unlimited supply of ammunition because their ammunition are digits on a computer. It's not even gunpowder and brass, casings. And the way banks work is the more assets you have on your book, the more you can lend out. And the Fed runs as a bank because it is, in fact, a conglomerate of all the different Federal Reserve banks. And so as the Fed has bought these various debt instruments and printed money against them. They bought about $4 trillion worth of debt instruments, and they've added that to their assets. That has increased their asset base from $1 trillion in 2007 to about $4 trillion now, and that gives them more buying power. So in early 2009, we were talking to the Fed, and we were saying, people are complaining because you've gone from $1 to $2 trillion, and they say you don't have any more bullets. But we look at you as a bank, and we say you could go to $20 trillion, given the fact that you have $2 trillion of bonds in your portfolio. And they said, no, it's not. It's not that much. I said, well, how much is it? It's 18 trillion. I said, oh, 18 on top of the 2 you already have. They said, yes. I guess, so it's 20 trillion in total that you could go to. Oh, yes, but we wouldn't do that. I said, but if you had to, you would. They said, if we had to, we could. Now they have 4 trillion, so their lendable amount, if you will, is 40 trillion. And would they do that? They would hope that they wouldn't have to. But if you get into a situation similar to 2008, 2009, but worse, where it's a matter of let's print another $10 trillion, buy $10 trillion worth of bad debt from various people and throw it in our portfolio, or allow us to go into a Great Depression, worse than the Great Depression of the 30s, similar to the Great Depressions that we saw in the 1870s, 80s, and 90s, with a collapse of the dollar and major deflation. The Fed will choose to print money, and they do have the capacity to print more money. And they've learned both from the Great Depression itself and from the Great Recession of 2007, 8, 9, they've learned to be more forceful rather than more cautious.
Now, a lot of people thought quantitative easing would bring hyperinflation. And needless to say, we haven't really seen the velocity of money move. Matter of fact, I think it's at all-time lows. So a lot of the money that's being printed really hasn't worked its way through the system. Right. Do you see any political changes on the horizon that could force that money to start to percolate a little bit more?
Well, I think what would have to, and that's why we haven't seen inflation. And unless it does, you might not see an inflation. And even when it does percolate into the market or into the broader economy, you might see it sterilized through bond sales. By the Treasury, or by the Fed, which could suck up some of the excess liquidity if you see inflationary pressures. So we may not see inflation. The one thing that worries me is, there is a movement among some congressmen to cause the Fed to not be an independent bank, but rather to have to respond to the directives of the Congress and the administration. And my view is, you may have criticism about the way the Fed is doing things, but look at the Congress, and do you really want Congress people
turn that over
controlling
to them?
the bank?
Yeah.
I mean, do you want to give control of the nation's bank to Congress people? I mean, that's just really scary, to me. And that could be really bullish for gold.
Yeah, I can imagine. Yes.
But that's probably the major political change, because otherwise, I think what you've tended to have, Bernanke, I think, was a big exception to the rule, but you've tended to have technocrats run the Fed. And I think Yellen probably is too technocratic. Greenspan was a technocrat, but he understood markets, and he had a sense of markets that his two successors haven't had. So I think if the Fed stays independent, we probably are in better shape than if they come under the control of the Congress and the administration.
Now, I loved it today when you talked about America and you said America's great. And a lot of people in the gold business, they always talk about the demise or the death of the dollar. And I think in your presentation today is the dollar's not going anywhere. It's going to be around for a long time to come. And obviously we could see price fluctuations. Do you see the yuan potentially in the future being a key reserve currency?
I see it being a key reserve currency, not the key reserve currency. And the People's Bank of China sees it that way too. The last thing they want is for the yuan to be the reserve currency of choice, because they've watched the French and the British and now the US really damage their economies by allowing their currencies to become the currencies of choice. And what a lot of central banks, including the Chinese central bank, would like to see is a slow movement away from the dollar being the de facto reserve currency of choice to a multipolar currency system, but it's going to take a long time. It's going to, for two reasons. First off, individual countries have to change their rules to allow individuals to own their money in whatever currency they want. And most countries don't allow that right now. So there's got to be major reform on a country-by-country basis. The second thing is, if you owe the world enough, you own it.
Yes.
And with 60% or so of the monetary reserves denominated in dollars, and probably 70 to 80% of private sector financial wealth denominated in dollars, the world is so awash in dollars that if you said today, well, let's replace the dollar with a basket of other currencies, it would be so hyperinflationary to those other countries because they would have to print so much money. If all of the other currencies combined represent only about 40% of the world's monetary reserves and only about 25% of the private sector reserves, you really can't make a fast transition away from the dollar. So as long as that's the case, there's a case for keeping the dollar and for strengthening the dollar. In addition to that, there's something very important. And yeah, I do take offense with those people who say they want to make America great again, because America is still very great, and it's very strong, and it has a number of resources that every other country in the world envies. We have an installed manufacturing base, installed industrial base. We have an education force that's par none. If you look at the universities, the top-rated universities in the world, it's down. It used to be that 9 out of 10 were American. It's probably about 7 out of 10 now. We still have natural resources. People don't realize that we're still one of the world's largest producers of all sorts of agricultural commodities as well as industrial commodities, copper, coal, steel, iron. We're still in the top handful of countries in terms of a lot of that stuff. So we have all sorts of capacities that tend to get overlooked. And our manufacturing output, if you look at it, our manufacturing output is, I believe, 50% higher than it was during the Reagan administration. We haven't lost manufacturing capacity. What we've done is we've lost manufacturing jobs.
Right.
But we're producing 50% more in dollar value of manufactured goods today than we were 30 years ago.
Now, needless to say, if you invest in gold, you're not betting against the United States. You see uncertainties out on the horizon that obviously could force investors to move a little bit more of their portfolio into precious metals. Now, you talk about a couple of different variables. You talk about catastrophic insurance. Mm-hmm. You talk a little bit about wealth preservation. And you also talk a little bit about wealth accumulation. And I like the way you termed it today. You said, we look at having different silos. Could you expand a little bit on that?
Right. Well, we advise wealthy individuals and people like Monex who advise other individuals too, as well as wealthy individuals. And when we get a client and they'll say, well, how much percentage of my wealth should I have in gold, and why should I have gold or silver? We talk about these different silos because gold and silver each have different functions for each individual investor. And the first function is that catastrophic insurance. I may not think that the world's going to collapse, but I do think the world will suffer numerous problems over time. Crises, recessions, perhaps bouts of deflation, bouts of inflation, and there are large long-term structural issues like international labor, international cooperation, a movement to a multipolar currency. There are a lot of problems that are out there, and those problems will cause issues in the markets and the economies from time to time. They may not lead to a collapse, but they're going to be bad. And you should have some portion of your wealth as a catastrophic insurance policy in case things really do go bad. Americans tend not to see it because we've had a relatively stable country. But if you go to China or Southeast Asia or Europe or the former Soviet states or Africa, where you've had regime change and government change and currency replacement, where one day you wake up and the currency's gone, another day you wake up the president's gone, you find people saying, okay, I want some of my money in that insurance policy in case things do really go bad. And that insurance, what percentage of your wealth, depends on who you are. If you're very wealthy, it may be a relatively small percentage. If you're not so wealthy, it's probably going to be a much bigger percentage. But then you should also have gold and silver as what we call long-term investments. just to have a diversification of your portfolio and a diversification of the currencies in which your wealth is denominated, if you will. So rather than have all of your wealth denominated in US dollars, have some denominated in gold and silver. And then there's a third role that we look at, which is more opportunistic. Metal that you buy and sell. And understand, gold and silver are markets. They rise and they fall. There are a lot of people who think that gold and silver only rise, and there are a lot of people who think that any decline is because of some conspiracy. No, these are markets. They rise and they fall. So it was very easy for me when gold was $270 in 2000 to say buy gold. It was very easy for me when gold was $1,860 in January of 2012 to say it's a time to sell. And right now it's a difficult, well, no, not right now, it's easy. It's easy to say this is a good time to buy gold. But I think that if you can be opportunistic and you have this long-term holding that you keep, but then you have another position that you buy and sell, depending on where the price is, you will do a lot better over time.
Well, one, when you showed me the chart as far as your buy recommendations, right, absolutely impeccable. And you admitted that you liked gold at 1,300, which a lot of analysts will come out and say, well, we got stopped out of that position. But today you said something that got me excited. You felt that we're getting very close to a bottom, and that if investors are thinking about getting into precious metals, now may be a great time to do so. And obviously with all of the different catalysts, and you talked about numerous days of reckoning. What was, explain that term a little bit more.
Well, I was in a discussion on the long-term outlook for the global economy in 2013. And the other participant was a Federal Reserve economist. Okay. And people asked us about the debt situation. Is this untenable? And he said, yeah, I think there has to be a day of reckoning at some point. And could be in the distant future, or it could be near, we just don't know. And I said, I don't think there's a day of reckoning. I think there are many days of reckoning, because quite frankly, what you look at, the way the world has worked for the last 500 years, is that you have this massive buildup in debt, and then you have a crisis, as we did in 2008, 2009, and we find a way to paper it over. So I think that there'll be a day of reckoning, and the devil will stalk the surface of the earth, and we'll engage him in a poker game, and we'll buy ourselves another 5 to 10 years. And then 5, 10 years later, we have another day of reckoning, and the devil comes over and says, this time the odds are in my favor, we'll play again, and we buy another 5 years. That's how the world's economy has tended to run since 1400. I mean, if you look at Spain, the golden age of Spain was the 1500s. Spain ruled the world. Spain went bankrupt 3 times during that century. And each time it did, it went off to the private wealth holders of Europe and said, we're Spain, give us more money. And they said, okay.
One of the things you did say today, though, and I loved hearing it, because it's always good to have a potential target out on the horizon. You were talking about the market potentially making new highs, gold breaking above that $1,900 level, maybe silver. You didn't give a number on silver today, but you did give a date. You said sometime in the next 3 to 4 years, by 2020. Can I tie you down on that one?
Yeah, I think that, we look at gold. Let's look at gold specifically. And we see 3 really big positives. It's just a matter of when they're going to come together. One is that investors have pulled back from buying as much physical gold as they have been, but we think that the economic and political environment at some point, it may be this year, it may be in 2 years, 3 years, is going to cause investors to step up their gold purchases again. When they do, they're going to find that there are all these central banks, including the Chinese bank, that have stepped up their gold purchases, and the gold market will be that much more crowded. So they'll start competing with central banks for scarce gold resources. And we look at mine production. We think that gold mine production will probably continue to grow this year and next year, but after 2017, world gold mine production is likely to fall very sharply. And that's pretty much baked in because of the long lead time for expansions and new developments of mines. We think that the current low gold price has starved the gold industry, and you will see mine production fall. So if it takes until 2018 or so, you get this trifecta there, where you've got investors stepping up their demand for gold. When they get to the gold market, they find it's crowded with central bankers, who have a lot more money to spend, but are probably actually more price sensitive than private investors, at a time when mine production, newly refined supply, is falling. And that, we think, could cause the gold price. We expect the gold price to move modestly higher in the interim, maybe get to 12 or 1300 by the end of this year, depending on what happens with the election and the stock market and the dollar, move a little higher in early 2017. But at some point you hit this inflection point, and we think the price starts accelerating rapidly. And by 2020 or so, we think you'll see nominal prices at record levels.
One thing you did say today, though, something about the long term suddenly becoming the short term. What was that all about?
I'm a very big bull on the long run.
Yes.
Short term, I'm probably more moderate than I'm sounding today. And again, you referred to my track record, which has been pretty good. We've had our faults. Yeah. But we've had a pretty good time. And one of our strengths is, if you look at 1980 to 2000, 68% of the time we were telling people, don't buy gold, sell it. And we're willing to stand down. And we're willing to tell investors, we have had investors, we've had multi-billionaire investors, we've had the world's largest hedge fund at the time come to us in 1990 and say, we think that we should be buying gold, but we were having dinner with one of your clients last night, and he said, before you buy an ounce of gold, talk to CPM Group. And we told him 5 reasons to not buy gold and what we were looking for to turn bullish. So he shorted gold from 1990 to 1992, late 1992, right after the election. Mm-hmm. And in late 1992, actually before the election, we told our clients, things are changing, and we think that by March of 93, the price will rise. So he sold off his short position, went long. Everybody was bearish, so he bought these grossly out of the money puts or calls, options, and he made a fortune. Mm-hmm. And he made the newspapers, because he was so big. And so we have this view, you will find people in the gold market who have been telling you that the treasury is going to collapse and gold prices are going to skyrocket for 40 years. And someday they will be right. We have a reputation where we've been saying, now's a good time to buy, now's a good time not to buy or to sell. And so when we come along and we say now's a good time to buy, I think we have a little bit more cred on the street, because there have been times like January of 2012 where we said a time to sell.
Right.
Get out. And it's funny because people will ask us, well, how much money do you have under management for your clients right now? And we say very little. So why is that? I said, well, because we told them to sell it in 2012, and they said, go for it. So we sold off most of the assets we were holding. And now people are reluctant to get back into the market because they're not convinced it's the bottom.
Now, in the banks right now, Jeffrey, I got something from the bank the other day. It was 3-year CD for less than 1%. Why would somebody put $500,000 in a bank, get paid less than 1%, when you could potentially buy gold at approximately $1,100 an ounce? And if we see $1,900 gold in the next 3 to 4 years, that's a quality return.
Yes. Oh, yes. And in fact, one of your guys showed me an article this morning in which somebody pointed out that if you had bought the stock market in 2008, you'd be up a certain percentage, today from where it was, even with all the gyrations in between now and then. But if you had bought gold in 2008, you'd be up probably double as much. And people overlook the capital appreciation potential on a long run basis in gold, and that's still true, and it's going to continue to be true. I wouldn't put $500,000 or anything into a CD, a 3-year CD at this point. I would be looking at, and in terms of my own personal portfolio, I have much shorter term cash instruments, because I just don't see how it makes any sense to lock up your wealth in such a low interest product. And again, because I'm all about diversification, if I had $500,000, I wouldn't buy a $500,000 1% 3-year CD. I would put some money into short-term interest rates. I would put some money into gold and silver, and I would probably put some money into other assets too, to give myself, it's like playing roulette, and you put chips on a number of the squares.
Jeffrey, we've taken up so much of your time today. We're absolutely so excited that you were able to come in and speak with all the account reps. I think these reports are absolutely phenomenal. What you shared with my guys today was incredible. It really fired them up, because I think what happens, you've been beaten down in the trenches, and needless to say, sometimes you just need to see a light at the end of the tunnel. What you're saying, though, is we're not sure how big the tunnel is, but there's a light out there for gold buyers that take advantage of the current prices, and silver buyers and palladium buyers. You feel pretty confident about that.
Right. I'll just go back to a question you asked, which I don't think I answered, and I said it in your presentation. You can look at the gold market and you say long term, there's a lot of reasons to own gold and expect the price to rise sharply. And you just don't know when that long term becomes the short term.
Yeah, that's exactly what you said.
You wake up one morning and the price is up. And because of the potential of those shorts flipping and going long, when you start seeing the move, it will go fast.
Fantastic. Well, I hope everyone enjoyed Jeffrey's comments. I think you would absolutely love to read these reports. We are a big believer in CPM Group, and I think you'll find this information absolutely incredible at helping you make a decision whether precious metals fits as far as your portfolio. Jeffrey, thank you so much again.
It's always a pleasure.
Have a great day.